Robschild, no investment advice. Welcome to the show where we view financial markets using Benjamin Graham's investment philosophy, macro technicals, and a touch of crystal ball gazing. Today is Thursday, January 23rd, 2025. Today's episode begins with Trump regarding rates and crypto stockpile, notably not reserve. The front page of CNBC has a headline, President Donald Trump says he'll demand that interest rates drop immediately. And what do the traders say about that? Well, no. 100% chance of no cut next week on Wednesday. So this market's laughing in his face, but the stock market got a little bit of a bid today, interestingly. And, the rest of the markets didn't really budge on that news, so I don't think anyone's really taking that very seriously, except it may have, like I said, gave a little bit of a spark just to the S&P 500. Everything else seemed unaffected. And then the second headline about Trump is that he signs executive order promoting crypto, paving way for digital asset stockpile, notably digital asset stockpile, not Bitcoin, not even Bitcoin stockpile. So maybe it'll be a Trump coin stockpile or a fart coin stockpile. Whatever you're holding, guys, cross your fingers. One important piece of this is that it's a stockpile, which is typically something that's seen as more shorter term, or maybe not. We're taking this very seriously and not putting it into a reserve, like a serious, okay, we're an investor in this and we're holding on to it for, security of our financial system. And I will comment on that I think that that's probably a good idea. However, whatever your opinions are on Bitcoin, if we were to go to having the world reserve currency be Bitcoin instead of the dollar, that would cause a worldwide depression like the world had never seen. And it's only because you can't print Bitcoin. You can't create Bitcoin out of thin air. You can't borrow Bitcoin at an interest rate. The whole point of money, the monetary system functions on credit. And it'd be a very scary world if Bitcoin actually did become the world reserve currency. But hey, I've been saying there's a depression coming anyway. Maybe that's it. Maybe that's it's going to happen. I doubt it. I think that, crypto is in a type of bubble that will be looked at, in the future to today, looking back in time as like one of the greatest asset bubbles of all time, just like the dot-com bubble, just like housing bubble in the Great Financial Crisis, the tulip bubble back, I think, 1600, something like that. Railroad bubble. There was a land bubble in Maine, I think, and there was another one in Florida. I recently learned about. Bubbles happen, and they're not known as bubbles widespread until they pop, until they go away. And I see that as the more likely scenario. Next item on the agenda, I wanted to bring up initial and continuing jobless claims moving higher. While initial jobless claims is moving higher, it's not moving higher at an alarming rate. It is higher than what the market was expecting, but this is not the kind of explosive, like we are in a recession kind of move. However, when you look over to the continued claims, this is a new high here, and it's only a tiny bit above the last high, which was set in the week of November 9th, 1.898 million, and now we have 1.899 million. So a new high in continued claims. So people that are continuing to claim that their insurance for unemployment. One more look at this of the continued claims chart. Again, this is from the Fed, the Federal Reserve Bank of St. Louis website. Going back to 2022, when this had bottomed, this has been going up and up and up. Looks like maybe it was going flat, maybe crawling over. Nope, higher high, higher high. We keep getting higher highs here. So this is, right now, looks like it may be running away. I mean, all in all, if to be fair, it looks flat more than anything, but something to definitely be watching. Last agenda item, I talked about the leading index yesterday and how, these charts are all pointing down. Well, they finally updated the chart that I usually reference with the actual reported numbers with the November adjustment too. And so it's all correct now in this chart. And I'm talking about from tradingeconomics.com. They finally updated it. Before, they showed I think the October and the November going lower, and they finally, so November got revised higher, and then went down by 0.1%. This finally makes sense. If you remember yesterday's show, I was complaining about different sources showing different things. I guess they update different times, but any way that you see this, this is a pretty good bounce here, and I'm starting to wonder. Is this going to turn around? Is this headed higher? I mean, when we zoom out, for example, on this, and we look at the .com, the .com bubble burst, there was no bounce that significant. You can see it right here at the end of the chart. It's a pretty good bounce. And the .com bust, it just went straight down, and that was it. And things were terrible in the Great Financial Crisis. Spiking down during that whole, terrible time. It typically goes down during these times, and is this actually the bottom here? I don't know. I will say that if we see continued month after month an increase in this, that takes the idea of the economy, the economy going into a major recession. It lowers the probability of that happening. I mean, this has to keep continuing downward in order for a recession or depression to really play out. Again, the U.S., just to read what this leading index says, is it anticipates turning points in the business cycle by about 7 months, it says. And so, if this is the turning point back up, then things will clearly be better in 7 months from now. Is that the idea? I don't know. But so the 10 components, again, they include average weekly hours for manufacturing, average weekly initial claims for unemployment insurance, manufacturer new orders for consumer goods and materials, ISM index of new orders, manufacturer new orders for non-defense capital goods excluding aircraft orders, building permits for new private housing units, and S&P 500 index of stock prices, and the leading credit index and interest rate spread 10-year treasury bonds less the federal funds rate. Includes a whole enormous amount of things, and again, when there's a recession, it's going down, and we're getting a heck of a little bounce here in this. I find it very interesting. I'm guessing with my crystal ball, it'll just, we will see it collapse down further, and if it doesn't, I'm going to be, I don't know, I'll have to take my bearish case off the table. Probably get out of the bond positions and try to seek out areas that I think are worth investing in more equities at that point, if it plays out that way. But I'll need to see it going higher and higher for, I'd say, 3 months before I start getting confident about that idea. I read through the daily reminders every once in a while. The last one was macro update 110.25, dominoes in the ball, to hear me read through things that I think are incredibly important. There is one update today, which means I may have to redo my daily reminders soon. But the leading indicators is no longer exactly collapsing. And so we're going to have to say pausing here. And again, if this turns around, that would be really bullish. I would be I'd be a dead bear. It may kill the bearishness that I have. This is a really important metric that I check on a daily, well, every time it updates at the very least. And yeah, but the rest of these items remain the same. With the rest of the items remaining the same, the crystal ball ratings still do remain the same, and I explain all of these in my macro show. On to the charts, the S&P 500, the SPX. We did it. We broke above the 6,100 level. Now, is that it? Is the S&P 500 for sure heading higher here? Professional chartists will want to see another close above today's close in order to get really bullish. What often institutions will do is push up the price past points like these to basically squeeze out bears, to, like kill all the bears, like, trigger all the stop losses. And so this could be really like a short squeeze kind of a situation. And if that's the case, we'll see it go straight back down even tomorrow. But if we see it continuing higher after after this major breakout above 6,100, it'll be looking bullish, and the next stopping point from previous trend line I had drawn will be around the 6,300 level. Again, I think what really helped break the market higher may have been that news about Trump saying that he's demanding lower interest rates. Why don't we skip to that? I mean, I'd love lower interest rates myself, since I have 58% of my portfolio in long duration treasury bonds, but I'd like the lower rates to be on the longer end of the curve. He's obviously more referring to the short end of the curve. And anyway, you look at it, none of the rates budged today. The federal funds, 100% chance of no cut for this meeting next week. And the 10-year treasury note yield, not moving at all. Doji here, just a big fight there. I still think this pattern looks like a bit of a head and shoulders top potentially playing out here, but we'll see. I tend to see head and shoulders and use them before they fully play out sometimes, and it's generally a bad idea, but touch of crystal ball gazing in this one. The dollar I talked about yesterday forming a bear flag off of this, and that is still forming. The dollar looks like it wants to drop down from here. Moving on to oil. Oil continuing its blow off top. I mentioned that when we dropped, it was Thursday or Friday of last week. I said this is blow off top. When you have a huge move up and then it suddenly goes back down, that's a blow off top. And yeah, with all of these candles, this is a lot of momentum here. So this is looking pretty darn bearish. Oil, I expect to continue to drop from here. Of course, we should see a bounce, especially sometimes some people like to use a time count of 7. So if we have 1, 2, 3, 4, 5, 6, 7, today is day 7. And so some traders will be like, okay, there's probably a bounce tomorrow, and then probably we'll head lower. So what are you gonna do today, Mr. Trump? We're gonna buy a bunch of crypto in a stockpile. Well, Bitcoin didn't get that excited off of that, and part of the reason is also that he said crypto and not Bitcoin, like I said at the beginning of the. I think I mentioned at the beginning of the video. I re-recorded. Anyway, what is crypto? It's because it's not just Bitcoin. Are we going to get a stockpile of Trump coin? How about fart coin? How about Dogecoin? So yeah, Bitcoin just ignoring that, looking like it ignored that news completely, from what I can tell. Some of these headlines, about what Trump is doing here, signing there, the markets aren't reacting. I was expecting bigger reactions off of him saying these things, and the markets are mostly like keeping sort of a level head, very interestingly. One other chart that really caught my eye today, that I've discussed many times on the show, is the high yield junk bond spread. The spread between junk bonds and treasuries is only 2.59% now. Looks like a new low, of this cycle. And, again, scrolling out, I say this all the time, but it is very, very rare and strange for people to only expect 2.59% higher than what you can get on a treasury bond. And notable times when this has happened in the past was right before the great financial crisis, when it was only 2.46 before exploding all the way up to 20%. So it screams that there's complacency in the market, that people are willing to lend their money at way higher risk than normal for the amount of extra yield that they're able to get on bonds. When I see stuff like this is a huge warning sign for me. But that's just me and my crystal ball, and that's all from me and my crystal ball. I hope you enjoyed. Thank you for all the support. Thank you for watching, and see you next time. Robschild.